Welcome to Topic 3. Topic 3 will build on the knowledge that you've gained in Topics 1 and 2, but particularly on Topic 2. There are three main subtopics. We'll look at the concept of accruals, we'll look at cash flow statements, and then we'll start on financial statement analysis, specifically focusing on profitability. One of the themes that you will be noticing within Topic 3 is that of the difference between cash flow and profit. And this is explored through all of those three subtopics. Your learning outcomes for Topic 3 will be to understand the accrual concept and the impact that that has on the financial information that you'll see on the balance sheet and income statement. To appreciate and understand the contents of a cash flow statement and what that information conveys. And then to be able to do a profitability analysis on an organization using their financial statements. A point to note on the readings that you've been prescribed for Topic 3. They will continue through into the further content of Topic 4. So you won't have to revisit them, but just bear in mind that they're covering across both of the aspects. Accrual accounting. Accrual accounting relates to the timing of when we record transactions, particularly our revenues and our expenses. The way most businesses run, certainly larger organizations or any that is other than very small organizations, is on that accrual basis. This has implications into two main areas, in the recording of revenue and the recording of expenses. Before we examine those, accruals is really an issue of when we're going to record items into revenues and when we record them into expenses. So that issue of timing, and it arises in a situation when we make payment in a different time frame to when we incur expense, or when we earn revenue in a different time frame to when we receive the cash for that revenue. This is when accruals come into being. Let's turn our attention first to the revenues. In a previous video, I gave an example of earning revenue through a cash sale, and that was relatively straightforward. Our timing of receiving our cash was exactly the same as the timing of earning revenue because it was a cash sale. But more often in business, the timing between getting our cash receipt is different to that of the timing of earning a revenue. And this is where accruals comes into being. A rule in accrual says we may only record that revenue when we've earned it, irrespective of when we receive the cash. That might give rise to two different situations. Sometimes we will receive the cash before we've earned the revenue. And in this situation, we are not allowed to record that cash received as revenue. In that situation, we need to record that cash received, in fact, as an obligation, as a liability. You might recall we saw that in JB Hi-Fi, the income in advance. Different names for that could be called revenue in advance, or it could be deferred revenue or deferred income. All of those about the same concept of we've received in cash, we haven't yet performed a service, and we have this obligation. Another type of accrual could be the opposite. We perform a service and haven't yet received the cash. We're familiar with that one. And in that situation, we can bring that revenue into our books, and we will be showing an asset, that of our accounts receivable, the customers who owe us money. Let's turn our attention to expenses and apply a similar logic. When we pay an expense in the same time period as we incur it, easy, no adjustment needed. But we might pay for an expense before we actually incur it. So this could be a subscription, a license. We make an upfront payment and we'll have use of that item for 6 months, 12 months, for a time period. In that situation, we don't actually show that payment as an expense at the time we make payment. In that case, we show it as an asset, and it'll have a name along the lines of a prepaid asset. It'll be shown in our current assets, showing that we've got benefit, recalling that an asset is something that brings us future benefit. As we then use or gain the benefit from that item, so as we have use of that item for which we've got the license fee, we will progressively remove or reduce the value of that asset and show it as an expense. The counter could apply. We might pay for an expense after we've received the benefit. And again, we're fairly familiar with this one, and we would see that liability as an accounts payable in our books. So the expense comes in well before we've paid the cash, but we show that the corresponding liability. In both of these scenarios, both on the revenue and the expense, what we're seeing is a timing difference between when we're making that cash payment or getting the cash receipt and when we're showing the revenue and the expense in our books. This has an important implication. What it means is our profit calculation will be different to our cash that we've got recorded in our books. Recall that profit was calculated from revenue minus expense. And if we've recorded revenues and expenses on accruals, i.e. when earned and when incurred, that may well be different to the cash in our books. And this means as financial managers or as managers observing or evaluating financial position of an organization, we need to manage both financial profitability and the cash flow position. To recap, accruals is a timing issue, and we run our books on an incurred and earned basis, not on a cash basis. This has important implications for how we measure profit, which means we need to manage and measure our profit in addition to managing our cash.